Between polarizing politics and news media bias, Americans often see the economy through a prism. Facts important to managing wealth for the long term all too often lose their context. Nuanced colors become black and white. For instance, the Bureau of Labor Statistics announced on June 2nd that 138,000 new jobs were created in May, and much of the press coverage reflected limited understanding of the facts. CNBC, the nation's leading basic cable TV financial channel, characterized the new jobs number as weak. While it was slightly below expectations, the 138,000 new jobs figure is actually strong in the context of the 9-year economic expansion. New job creation is limited by the demographics of the American workforce. The U.S. is simply running out of working-age people as the baby boom generation ages. This is not such a bad thing at all, though you would never know it if you get your financial news from CNBC, which reportedly attracts the highest income viewers of all cable TV channels. What's really happening is that the unemployment rate in May ticked down 0.1% to 4.3%, below the 4.4% bottom reached in the last expansion in 2007, which shows that the job market is tightening. Signs like this at a Home Depot in Denver are starting to appear. When was the last time you saw a sign inviting 16-year-olds to apply for a job? A tightening labor market means wages rise, and that's good for the economy. Just released data shows average hourly earnings figures are accelerating. At 2.5%, May's 12-month growth in average hourly earnings accelerated faster than the 2.1% averaged in this 9-year expansion. Meanwhile, employee compensation is booming, reflecting the tighter labor market. Employee compensation is important because it's the main driver of personal income, which accounts for 70% of economic growth. Employee compensation grew by 3.6% in May compared with 12 months earlier. That's much higher than the 3% 12-month growth averaged at the peak of the last economic expansion. This is good news for the economy. With inflation mild, real income is growing, giving consumers more to spend and save. That makes it easier for the Federal Reserve Board to promote growth. The Standard & Poor's 500 index has been hitting new highs, and stocks have boosted returns on diversified portfolios in this latest leg of the long bull market. Earnings growth projected for 2018 has been driving stock prices. Driven by an average annual earnings growth rate of 7.3%, the S&P 500 averaged a 7.3% gain annually since 1926, and that's without including reinvestment of dividends. Stock prices relative to expected earnings are reasonable in the context of their long-term history. With the media and partisan politics distorting the facts, world news breaking daily, and stocks priced near an all-time high, a correction of 10 or 15% in the stock market could occur at any time. Looking past the distortions in the media and political biases, however, economic conditions are strong.